Okay, good morning everyone and welcome to this live intraday strategy webinar. Today is Wednesday, December 14th. FOMC day is finally upon us. Welcome to everyone in the room, Graham, Conwell, Mike, Eileen. We just got the release of retail sales for the United States, slightly softer than is expected, as you can see in the screen here, bottom right-hand corner. Even a downward revision to the previous month. You're seeing some dollar weakness, wouldn't really move anything too heavily on this ahead of the FOMC, obviously, which is on tap at 2 o'clock, but certainly a softer print across the board for retail sales in November. Okay. Sorry, just taking a second here to read through some of your questions. Mike, yeah, we're going to go through a deep look at the dollar crosses today, and definitely the implications for the release. So again, welcome to everyone in the room. We're going to go over the dollar index. We'll start off with that. Yesterday's update included Euro, Aussie, and dollar CAD, which I'll be closely watching today alongside dollar yen, to continue like that to the downside. Sterling dollar and sterling yen, we'll do a quick update on those. And then we'll touch base on silver and crude for Conwall. Again, crude, I still think there's some more downside. You're seeing some weakness here to start off the session. Still think there's some more downside here in crude deeper into the session. Okay, so before we get into the charts and the setups that we'll be following into the release, I do want to give you a quick preview on what we're looking for with the FOMC announcement later today at 2 o'clock. Again, keep in mind this is your quarterly projections meeting, so you get those updated targets on growth, inflation, employment, interest rate, dot plot, and certainly that's what the focus will be. We're expecting 25 basis point cut, or a hike rather, excuse me. I'll show you the overnight index swaps in a moment. Mike with a question here saying, hi, Michael, crunch time. Would you please share your take on the following? As I see it, there are two opportunities, one short-term and one longer-term, based on a status quo Fed statement, short-term U.S. dollar pullback and longer-term U.S. dollar rally. What do you think of this assessment? And if you agree, how would you trade it? Mike, great question, very well-rounded. And I have to say this, I'm, I think, right in line with you. Within the context of the larger, broader dollar rally, yeah, the dollar is going to remain supported unless they come out excessively dovish, which I highly doubt is going to be the case. A broader pullback in the dollar definitely should be seen as a buying opportunity. Keep in mind the interest rate differential between these countries, which is typically what drives broader movements in currencies, continues to favor the dollar. I mean, no matter what pair you're looking at, the divergence in the monetary policy outlook alone continues to favor the dollar. So yeah, I think I agree with you on the larger theme pullback. That being said, even the near-term short on the dollar, and we all know we started the week talking about the dollar index at 101.69, 101.75 as near-term resistance. We got a really nice outside day reversal off of that level. Very nice reaction to a key resistance level that we've been watching, and the high day close for the year. That's all good and dandy. But I think even the pullback, Mike, needs to be treated with some respect. I don't think it's going to be a straight shot to the downside. And I'll show you in the near charts kind of what I'm thinking, Mike. I kind of think you might get an initial downside reaction. Traders will come in and try to fade that move. And I think you try to fade the fade for a new low. Just my personal expectation. I hate kind of like throwing that out there, guys, but that's sort of what I'm looking at heading into the release. Markets are pretty built in on one side of this trade. It's largely priced in. Again, a quick update on the overnight index swap sees that it's 100% priced in for today's hike. Now, interestingly enough, as you get deeper into 2017, that's what the focus will be. I'll come back to the dot plot in a moment, but here's what Fed Fund futures looked like last night. And remember, when you're looking to assess future interest rate hikes, you need to take the addition of the next two columns, right? So right now we're at 0.25 to 0.5. Okay, that's where we're at right now. The expectation is that we're going to see this move from 0.5 to 0.75. They move in ranges. That's here. So for us to get to 1%, it's going to require two hikes. Okay, and if you look down the line, there's really nothing above 50% until you get about here. Okay, in June. And in fact, that gives us two hikes next year. into December of 2017, there is expectation about 54% of another hike. That would be a third hike. So the major focus heading into the release is, does this hike materialize further or does it diminish? Because if this drops off the scale, then we're in with 2 hikes next year. We're looking to get about 1.25% to 1 to 1.25% into the close of 2017. That means the market kind of needs to reprice a little bit. So that would give us the downside move, I think, in the dollar index and the dollar generally speaking for the short term. If the dot plot is stretched out, we'll take a look at that in a moment, or you do see that dot plot tick higher, this materially ticks above 60%, then the pullback is likely to be super shallow. And in fact, if you do see a topside break above 101.70, you're likely to see a run at that median line. What else can I say about this? So the focus will be on that. Let me go back to this. I guess this is pertinent now. So here's this is a chart by Bloomberg in which they overlay what the Fed dot plot is showing, as well as what the overnight index swaps, the OIS, is showing as well. So in blue, you could see, or in red, I should say first, you could see as of the meeting date. So as of the last meeting, this is what the markets were factoring in as far as interest rates moving forward for each calendar year. Keep in mind, what's in green is what the Fed is suggesting. This is the median, not the mean, the median of where the Fed is seeing interest rates moving forward. Okay, so right about 1.25 heading into 2017, to the close of 2017 is where the median estimate is. So you could see heading into 2018, there's a little bit of a disparity. The markets are still pricing a little bit less. So there is room for the markets to adjust higher expectations for rates, which would be supportive of the dollar. Okay, we've already made a pretty big dramatic move from the last interest rate dot plot release. You can see the markets have sort of repriced that, and you'd see the dollar made a really nice rally. But at this point, you're looking at the longer end of the curve back towards the close of 2017, 2018 is really what the focus will be on. The dot plot from last September looked like this. Okay. By the way, here's the link. Anyone who wants to follow along, this is the link to the latest dot plot and Fed projection, so you can follow along. It's also provided for you on last night's update. But you could see where the distribution lies here for 2017. Again, just about 1.25 is where the median is. High stretch above 2%. Low stretch keeps us basically where we'll be today after that hike at 0.75. So there's still a little bit more divided as where we see it. Heading into 2018, obviously, the disparity gets even bigger. I wouldn't really focus on the 2018 or 2019 dot plot at this point. The focus today is going to be the 2017 distribution and where the longer run central tendency is. Okay, this is where the natural interest rate or the longer running interest rate should be. And most Fed officials see that about 3% right now. That is a dramatic decrease from historical standards. Now, remember back in the days when you used to put your money in the bank account and get 5% back. Now we're looking for years and years to get to 3. In any event, so we'll be looking for a shift in the 2017 and the longer run inflation dot plot targets. I'll give you an update on this on interest on the SB Squawk as soon as it's released with a side-by-side comparison. But these are sort of the focuses for the dot plot today. Also, the updated projections. This is going to be huge as well. Okay. What we'll be focusing on is the GDP projections. Unemployment is not going to be important, so scratch that as sort of a major marker. PCE inflation and core inflation are going to be the major runs as well. Note, things to take note of for today. First of all, really quick, the median, guys, is just basically that. That's what the median estimate is for the Fed officials as far as, where inflation and growth is. Central tendency simply shaves off the top 3 estimates and the bottom 3 estimates to give you more of a core of where the range is of Fed officials thinking we'll see growth and inflation. The range is just that. the high low and the distribution of where the Fed falls. So again, let's kind of break down that for you. But for the median, note a very important factor is that last September we saw them lower their core inflation from 1.9 to 1.8. The inflation targeting has been the Fed's biggest issue since the recovery. They've been trying to stoke inflation with no avail. Strength in the dollar continues to limit inflationary runs, just because, again, that works as a damper on inflation. So we'll definitely want to see if this upticks again to 1.9, they revise it back up to 1.9% again. That would be a pretty bullish sign that the Fed sees the recovery really starting to gather pace. If it holds at 1.8, I don't really think you make too much news out of it, but definitely take a look at that core inflation read. Will be absolutely paramount. Okay, so quick breakdown there of what we should be looking for heading into the release, what we want to be checking out with the projections and where those stand. Again, you know, at the release, you'll want to visit that page that I have linked for you right here, and that's going to get you, you'll see the newest projections pop up here right under the December part. You'll be looking for the PDF for the new projections. So it usually gets updated right at 2 o'clock. Obviously, this site gets hammered right at 2 from around the world. So sometimes it'll take a couple of minutes to load. Again, I'll have that posted for you on SB Squawk as well. Any questions on anything from the Fed, fundy-wise, dot plot-wise, projection-wise, anything that you have as far as today? Eileen says, and will you have time to talk more about the Fed and presidential office and any impacts that office can make on it? So, Eileen, I don't want to get, I don't want to step on any toes and get into any politics, but I can just tell you that the Fed's primary directive and function has been its solidarity and independence of government. So this whole talk with Trump wanting to come in and replace Yellen, guys, this is, I mean, my humble opinion. Again, this is just not realistic talk. So you want to take that for a grain of salt. As far as what they can do is leaning on the Fed. Again, in a vacuum world, that just, that doesn't happen, right? The Fed needs to maintain its independence. But I don't really think you'll hear Yellen address Fed, the Trump rally too explicitly. I'm 100% sure someone from the audience, from the reporting crew there, will press her on the Trump rally and what she sees the effects on the economy. I'm sure she will have some sort of staple comment that she'll come out with, but will it be anything material, Eileen? Will it be anything to actually shift monetary policy moving forward? No. Now, that said, certainly the Fed is definitely looking at this rally right now with some concern, right? They don't want to tell the markets that you're undershooting the inflation, the interest rate target, because they don't want to stoke further strength in the dollar. That's not going to help. At the same time, asset prices, I think everyone would say, are kind of expensive here, with all the major indices continuing to rip to all-time new highs on a daily basis. So it's going to be a very delicate balancing act, I think, for Yellen today. As it pertains to the presidential election, I really don't think we'll get any material commentary on that. If anything, she'll say that they're watching asset prices very carefully, and that they've been wanting further support from fiscal policy, and that they 100% support revisions to the fiscal outlook and the policy that the government is putting forward. So I'm sure she'll get all these rosy comments, but I don't think we'll get anything material. Eileen says, okay, wasn't sure if the Fed group could be unraveled. I mean, again, there's all kinds of, these are all kinds of like big movements, Eileen, but realistically, from a trading standpoint, for me, a trader sitting down, I wouldn't look too much into it. Rob says, I missed the first 10. Apologies if I explained this already. In a remote scenario of no rally by the Fed, would short dollar yen? Yes, and how? So, Rob, we're already short dollar yen. On the swing side of trades, we got short at 115.35. Target on that is 113.70 still, so that trade's already in. I'll go over the dollar yen chart in rather in just a few moments, but definitely a trade I'm looking for today. Roth says, if no hike. I was trying to read your comment. I didn't really make much sense of it. But Roth, I was talking with a couple of guys here in the city on that. Look, in the remote scenario that they don't hike, very, very unlikely. I think, to be quite honest, if you tell me what the biggest risk today, guys, as opposed to no hike, I think the bigger risk or a more likely risk is actually a 50 basis point hike. That's just my humble opinion. In fact, if you look at overnight swaps right now, Fed Fund futures, they're pricing in an 8% chance that we'll see a 50 basis point hike, 0% chance basically of a cut or a hold. So I think that's the more likelihood scenario. But if they don't, you'd expect to see a really strong dollar reaction initially, and then I think stocks would not be too constructive. I think you might get a spike in stocks, but I think that might trigger a pullback. That would show concern from the side of the Fed that things are not exactly on track of where they want to be. Remember, for all intents and purposes, guys, the Fed needs to hike today just to save face. You understand what I'm saying? We came into this year calling for 2 to 3 hikes from the Fed. It's December. We haven't gotten one yet, right? So if it's going to move and if they're going to maintain face, credibility for the markets, they have to do something now. So, Ralph, I wouldn't spend too much time wasting time on trying to, case that scenario per se. I think you're more likely to see that 25 to 50 basis point, more likely 25 hike. A quick look at another one thing I just wanted to point out, talking about the Fed's hand being forced here. Remember, at the end of the day, the markets are what's going to dictate what the Fed needs to do. Okay, and right now the markets are saying go higher. Here's a quick look at the yield on the 30-year, guys. And here's a stretch back into 2011. Obviously, your crisis, highs post the financial crisis, obviously, where we saw yields really come off the highs from above 5%. You could see throughout the course of this year, we're at the yearly high right now. Here's the start of 2016 trade, right? This is what the Fed has been welcoming. They've been wanting yields to start moving higher. They need, it'd be very hard for them to justify standing still on rates, even though the market has started to push the longer end of the curve higher. All right, so there's a lot of different arguments to be made, but all of them turn back to watch for the hike today. Okay, Ralph, good question. Hope that helps. All right, any other questions on Fed policy or anything that we should be looking for today? Feel free to throw them out on the message board now. Otherwise, let's jump into the charts. Here's a quick look at the relative performance of the US dollar heading into the open. You can see that the dollar is actually weaker against all its major counterparts. Slim shavings, I wouldn't really think there's too much losses here, but you have the pound, Kiwi, yen all down about 0.3%, about 1/4% on the rest, including the Aussie and the Swissy, or excuse me, the Aussie and the Euro, which we'll be looking at in a moment, showing nice gains here in overnight trade. Obviously, Aussie making it through the 75 barrier. Euro, still think we could get higher there in the short term. Here's what the dollar index looks like. Excuse me. You've been looking at this chart all week. We highlighted it last night in our update. It's basically the same exact chart that we saw on Sunday, no change. Key resistance 101.69 into 75. A breach higher, you're looking for targets at 102.07. And then the upper parallel comes in right around this region here. You're looking at like 102.60, 102.55. And then up there, beyond there, would be 103.22. But as long as you're below this region, the risk is for a deeper cut. Now, I would need to see a pushback below the 2015 high day close, namely the close lows that we made for this month. Key critical support is still all the way down here. I don't think, again, necessarily you get there today, but that's sort of the game plan if you see a break back below this parallel, which has offered some very nice pivots in price. Resistance from April, again tagged in June, a little messy in July, perfect tag in October, pivot, support, converges on that median line, and the high day close from last year. On the near term, there hasn't really been too much to get excited about. Remember, we pointed out this slope yesterday. I don't want to get too, again, ahead of myself here, but 100% extension, 2 equal legs down takes you into 99.16. 89.99 is also a soft pivot in price there. would fulfill that gap that we broke away from back in mid-November here, which we never filled. So it'd be sort of a nice target for the downside. Start looking for some support. Again, the 2016 Open converges on that slope over the next few days here near 98.70. If we break above the monthly open, it now converges at the upper median line parallel exactly. Boom. Okay, the monthly open comes in at 101.50. 101.75 being our bullish invalidation, or our bearish, invalidation level. Now, you can envision a scenario heading today, and again, guys, this is to be taken with a grain of salt. I'm just trying to give you like a feel for what you should be expecting. At the end of the day, trading these interest rate announcements are never simple. The announcement comes out at 2. The projections are released at 2. By the time she takes the stage and starts making her commentary, the markets are just digesting what's in the report. So look for some jackknife action. Again, if you're newer to getting involved in intraday trading, specifically event risk, today's not your day to get involved. Today's your day for learning and kind of watching price action. For me, this is my kind of expectation. If you get the knee-jerk reaction, they do raise 25 basis points, the dot plot shifts up slightly or holds for 2 hikes to 3 hikes in 2017, I think you get sort of a rip drop. Traders try to fade that drop higher, and then inevitably you sell that drop into the lows. So again, whether the initial reaction is a break higher or move lower, I think it does drop. The market fades that, and then you fade sort of the fade of the move, sort of a scenario I envision playing. If it rockets through 102, I don't want to touch it. I want to see where this thing sort of exhausts into, because really there's nothing until 103.22 beyond that. So does that make sense, guys, as far as dollar price action is concerned? Again, we'll have to see how the report or the projections come out, but the data has been pretty strong. Unemployment numbers have been continually getting strong. The inflation numbers have been picking up. If it's a rosy picture, the downside might be limited. So I really want to see where if it does spill to the downside, where that finds support. All right, so that's the ICE dollar index heading into the FOMC later today. Going once, going twice. All right, let's jump into the dollar crosses. Here's what euro looked like last night. And the major play on the euro here is still the fact that we continue to hold the yearly lows. I'm going to start off with the daily chart. Again, this is your December low. We made that low last month. We tested it again here this month. It also converges on the lower parallel for this formation we've been following since the highs that we made back in May. Again, we talked about this. There wasn't really divergence on a close basis. If you bring this into a line chart, there's really not any divergence here. So you couldn't really use that as sort of a exhaustion signal. But from just a pure horizontal base support, you got that lower parallel and those lows to contend with. Nice pop in price. Okay, the 50 line of this operative formation currently catching resistance. Could see a drop down lower, but I'd still be looking to buy that for a spike back into this gray line, this sliding parallel that extends off the lows from August. Here's what it looks like. I mean, the daily chart's pretty plain and simple, right? I think this bounce has a little bit more juice to go if you do get a pop above that 50 line. It's the near-term chart, really, that has the focus here. So I highlighted this on Daily FX as well. As I always say, it's early when you put these pitchforks on, guys. It's too early to put too much emphasis on it. But how do you know what you want to work with and whether it's something important or not? It's all about the parallel. The power of the parallel is extremely profound when you actually find a slope the market is working with. So in fact, this line that you see here is a 38.2, okay, % of this range. Another fib level gave me really nice touches on these last two, but how do I know? Just because of these two touches? No, go ahead and take a parallel and go to some recent highs and lows. Look at this. If I extended off that high, caught the exact high we made here. Look at this. Okay, if I extended off that low, looks like we got another touch right here. So there's a couple of different instances of where this slope has been fruitful. Again, I still don't want to put too much emphasis on it, but keeps the focus higher right now above the lower parallel. Now, obviously, we've had some time decay here since last night's report, so I'm going to go ahead and bring this up just a little bit, but you're basically looking to stay constructive well above. Now I want to say 105.70. The monthly open comes in at 105.87. Okay, look for a spill into this region. Again, that would be that initial spike in the dollar to fade. Be a move to the upside. Dollar weakness, euro up. Euro dollar looking to short it then if dollar does the fade. No, so if, okay, Eileen, I didn't need to break it down. You got it? Yep, okay, cool. So yes, longs from lower, right. Near-term resistance, as we noted last night, no change to any of the levels. The immediate resistance target at 106.58, that basic 38.2 retracement of last week's range still remains near-term. Will remain constructive above this. A topside breach, if we do see the barrier break there of the weekly opening range highs, I'd be looking for 107 as a soft target now, okay, because it's along that same median line. So I'm going to go ahead and drop this down to here, followed by the 107.40 level here. And that's a key 618 retracement and that gray sliding parallel that we talked about on the daily chart right here. Lost connection for 2 minutes. Where would you enter longs, please? So again, major key or support on the near term, Mike, where we want to stay constructive above is the monthly open, which is 105.87. I'd want to say into 105.70 is my key zone of support. Now again, don't get too tight on this, guys, because if we see some whipsaw action or if Yellen starts blabbing and this thing opens up, it could really just go for a test of the weekly open before bouncing. But that's my idea. As long as price broadly stays above here, I am looking for a topside break to target 107, more importantly 107.40. If the initial reaction sees dollar weakness, this thing spikes into that region, but there's a more hawkish statement, this might be a beautiful entry for a short side trade at 107.40. That's all to say, I think 107.40 is going to be a big player. You want to look for a rally into that region. You want to look for a reaction into that region in euro dollar. If we settle below the monthly open, below structural support here, sayonara. You know, there's really, as far as downside targets are concerned, guys, the last soft target I have is 103.73. I don't have anything beyond that. I'd have to go back and really check out some longer term levels beyond that. But this is still pretty critical for euro. Mike says, thank you, exclamation point, you're more than welcome. Hey, Mike, do you trade more than one pair on such event risk, or do you stick to stocking and trading one? So, Mike, I don't really put a limitation on myself. You know, I don't want to. There have been times where I was in 3 or 4 trades during interest rate decisions. There have been times where I'm completely flat. There are times when it's just one position. It really depends on where the market is, the opportunity I get in. The biggest thing I can tell all of you is don't try to chase. Okay? If I happen to be in front of my platform, Mike, and 3 of my targets are reached and we're at key levels, I'll take a small position on a couple different ones. Yeah, absolutely. You got to be in it to win it, A. And B, I'm trading with much lighter leverage, so I'm much more willing to spread myself out a little bit more. But if you take a position, now all of a sudden, oh, I was looking at euro and Mike was saying this euro level and it bounced off it like it was supposed to. Great, I'm going to jump in here. You start doing something like that and chasing on 3 or 4 pairs, you're likely to make a huge mess of things. And trust me, I've had, over the years, I've had interest rate decision days where I'd like to not remember, okay? Just because I tried to get involved in too much. So there's a happy balance. I can't tell you what that is, Mike. Everyone's got their own, you know, tolerance as far as how much risk they're willing to take on, how much pressure they can get under with all this happening at once. I can tell you that obviously, you know, I'm not 100% dedicated to just trading the announcement because of my duties here with SB and Daily FX, so I don't always necessarily get into all the positions I want to. but I would focus on one or two. I would say if you're in the swing trades, don't touch it. If you're in a longer term position trade, don't touch it. You know, these announcements very rarely have the propensity to actually shift or reverse trend. More so just trigger near-term interruptions within the broader trends that we're looking at. So if you're a guy who's holding a longer-term position, yeah, this all tends to be noise. You know, markets have been pricing this in for quite some time. For the near-term guy like me, it's all about using these swings for intraday opportunity and volatility. Does that make sense? It says, got it, thanks. How do you manage when volatility is so high? Again, Mike, we have our stops, right? We're never getting into a position hoping for the best. On my personal platform, I have the platform set so that as soon as I jump into a position, it has an automatic stop that comes up. Now, automatically as a preset, I have that set to 30, and then as soon as I get into the position, I jump into the trade management and I adjust the stop to where the level I want is. That's just to give me a safeguard. In case the market goes into free fall, I jump into a position, 2 seconds later, all of a sudden the market gaps down 60 pips. I don't want to be down 100, 200 pips on the position sizes that I'm taking, right? So I'll have that safeguard there. So for me, as soon as I jump into position, there's a stop, and I'm just going to adjust that stop as soon as I get into where I want it. That's how I kind of deal with really fast-paced moving markets. So a little trick there, Mike, that might help you kind of put yourself at ease a little bit. But if you find yourself unable to even get that in quick enough, then you're probably trying to put on too much at once. Take it easy. Okay? Questions on euro. Risk is for a move lower near term, 106, 105.87, 105.70. I'd be looking for some entries there or reaction off that mark. Look for a break above 106.60 to put this thing off, targeting 107, 107.40. And as I said, if you see a spike into 107.40, specifically the median line here on a drift higher, might be a nice opportunity to fade this. Some more dollar strength on the way down. Okay, that's number 2, euro dollar. Number 3, let's go over Aussie dollar real quick. I know on the Aussie we're still holding longs on the swing side of trades for SB. There's 75. We popped through it, came back, popped through it again. I talked to you about this yesterday. I don't want to beat a dead horse. I think it was a good call early in the week to kind of pull back our reservations for those shorts off 75 we've been playing for 3 weeks now. We're kind of straddling 75 now, and that's, again, something I'm paying attention to in near-term price. Keep in mind, just higher, you have the 200-day moving average, you have the 50% retracement, 75.45. Game plan for Aussie dollar is still to see this thing stretch a little bit higher. You know, the long side of trades, Jamie's looking for 74.60. Or excuse me, that was the entry. He's looking for 75.44, which is that 50% retracement. I think if you get higher from here, guys, you can get even a little bit higher towards the median line there, maybe even 76, which would be a beautiful region, in my humble opinion, for some short exposure. So keeping in mind 75.80, this whole region right here starts off today. I guess we'll bring this down here today with the 100-day moving average, the 50 line, the 1618 extension off the low. There's a lot there. There's a lot there. In fact, bear with me, guys. I do want to see what this new extension looks like. I don't want to stack up too many levels here, but I do want to keep an eye on this 100% extension. 2 equal legs off the low, taking into account the larger swing here as opposed to this first leg up, gives you 75.56. Another reason why that Aussie level might be pretty big. It's right here. Clean this up a bit. There we go. Again, this is a 4-hour chart in the Aussie. So you can envision a scenario once again where this thing continues to drift higher, gets into that 50% target. Again, just to bring you back to last night's update for Aussie, that would get you into this 50% region right here. A little bit higher gives you the 100% extension, extends into 75.57, 75.45, with really the broader bearish invalidation still at 76. So even if you get into 76, I still think it's a sell. Near term, I am looking for this thing to move a little higher. That corresponds to dollar weakness. So again, kind of a rip higher maybe in the dollar brings this back into support. The weekly open, this is near-term support and bullish invalidation. The weekly open, basic trend line support off the lows, median line, all converge down here. All right. So maybe a spill into this region, look for a reaction for a launch higher, or if this thing just completely, if the dollar falls apart right off the bat and this rallies into this region, might be an opportunity to look for some short exposure on the way down. In which case, by the way, you just tack on a quick retracement here and look to target those downside targets. What scenario will the Aussie dollar fall? Mike, did I just cover that for you? So for me, I study price action, right? My initial reaction is going to be to see what the dollar does. If the dollar initially rallies, then fades that past the open or past where we were pre-release, I would think that you'd still see dollar weakness, and that rally would push this into support and give me an opportunity to get long. If the dollar just completely falls apart, I think Aussie pushes back up into 76, and then you look for a reaction up there. I don't, again, guys, I don't have a crystal ball. I don't know what Yellen's going to say. She could say some pretty radical stuff. I don't think so. I think she's going to want to take a very tiptoed approach. But, have your game plan, have your levels set. And just a quick side note, as a respected Twitter or someone on Twitter that I follow who's a trader, who's been a trader for years and years and years. His name is Peter Brandt. We've gone back and forth over the years several times, and typically a big fan of his sayings and his kind of mentality on trading. But one thing I'll differ, guys, and he said a comment yesterday, and I'll just kind of throw it out there, is he said, with these kind of interest rate decisions, throw your charts out the window. They mean nothing. And with all due respect, I could not disagree more. Look, trying to ascertain the initial reaction, what's going to happen as soon as she comes out, it's impossible, right? But we have to have our levels mapped out. Having the broader view of the market is extremely important, and it still breeds tons of opportunity, this volatility. So absolutely, I would completely disagree with that statement. This is where you want to actually put more strain in your markets. You don't want to be looking at a 5, 10, 20-minute chart, yeah, but definitely, these stretches, these reactions can turn at major key technical levels. And nothing is more apparent on that than the euro dollar and what we did, last week. I don't want to go back and forth, but look where this thing turned. You're telling me that on ECB day that this thing randomly exactly top ticked at the 2016 open? I don't think so. That was an interest rate decision. Guess what? You guys had that level mapped out. You guys had it mapped out for days before here on SB. So don't take this whole like, oh, it's all going to be random. No, we have our levels mapped out. We have a game plan. We have a general idea of what the levels need to hold for this rally in the dollar to continue to be sort of feasible. And we know where we're looking for as far as support on the pullback. So, that's that. I'll just throw that out there. I saw that tweet yesterday. I wanted to say something, but Peter's a good guy. I don't want to bash him. Okay. Do you use the FXCM US dollar index, Sophia? I do not really. I'll glance at it every now and then. It's a great, what I like about the index is that it's at its inception, it's equally weighted Euro, Aussie, Sterling, Yen, just 4 of the most widely traded currencies versus the dollar, right, Sophia? So it gives you that really clean dollar base move. But over the years, the markets are all as a whole, the standard bearer for the dollar is still the ICE dollar index. So I do want to pay more attention to that. There is more market participation in that. It is so extremely heavily weighted, the euro. I completely recognize that. But with the index that's more widely traded across the market, it's something I tend to pay attention to a little bit more. On its face, the Dow Jones FXCM dollar index has made a simple, clean, and readily identifiable monthly opening range. Your monthly opening range highs start here with the monthly open, monthly opening range lows. We already tested it. 12.312 into 12.439. Very objective. So look for a break. I mean, the dollar index opening ranges have been pretty darn clear. Last month, here was the open. You ducked into a new low. You tested the open. You sat there for 2 days. Once you broke, you exploded into a new high. Previous month didn't really give you an opening range. It kind of just rallied the entire month. Previous month, the opening range didn't come till the following month, right? Here was the monthly range. We held the entire month in that range for September. October broke. Bam, new highs. So, you know, look for the opening range, I would say. If you break below the lows, or specifically this slope right here, I think that would give us the onset of a little bit more of a steeper correction to the downside. I haven't felt really comfortable tacking on a basic retracement, but if you do, off those lows, you know, just a basic 38.2 of the yearly range, or basic 236, still takes you down into 12,268. High day close from January, 12,280. So sort of your downside target on a break of the monthly opening range. On a topside break, honestly, on this, Sophia, you're basically looking at like 12,553. I don't really have anything above this barrier if we do get through. This is basic trendline resistance extending off the highs here. You have 3 touches, though, so it looks pretty decent. All right, interesting. Thanks. Where can I read about theory of opening ranges? Sophia, there's a great book called The Logical Trader by Mark Fisher. The Logical Trader by Mark Fisher kind of highlights his use of the opening range theory, specifically as it pertains to the commodity pits way back in the day. So it's a little bit of a different take in the way he uses it specifically, but the concept is outlined very clearly. And it's something that's been a big part of my trading over the years. Basically, Sophia, we're looking for the markets to set a really near-term high or low in price, whether it's on an intraday basis, a weekly, monthly, and look for that range break to give you a little bit more of an indication of near-term directional bias. It's not a strategy in and of itself, but certainly can be very helpful. All right, I'm running low on time here, so I'm going to start moving a little bit quicker here. You're more than welcome, Sophia, through the levels. Any questions on Aussie? So we took a little segue here to talk about dollar index, which was number 4. I do want to take a look at dollar CAD, number 5. This thing just bottom ticked. Oh, man. Still I'm trying to get in. I just missed the entry yet again, and so might still be a decent entry. Look, we've been watching this one for a while. Do you see where this thing just bottom ticked today, guys? Literally happened like 10 minutes ahead of the webinar. Just chatting away with another trade desk, and all of a sudden, boom. Here's where dollar CAD looked like yesterday. There's that key level of support that we were talking about, 130.80. Essentially, the upper side of that range is in the 131 handle. You know, if you recall earlier in the month, when we were brought up dollar CAD, here's what it looked like back on the 11th, okay? We were looking for a drop into that zone. We just got it. In fact, those of you who were in the webinar with us yesterday, remember when we just added this median line? All we did was take that median line support, or trend line support, take a parallel, notice that this parallel caught, just caught again. Okay, so in the scenario of dollar strength, I think dollar CAD's a really good candidate for a more profound rebound. You still would need to rally into 131.69 to fill the gap. Sorry guys, that's just the Bloomberg terminal going off there. Capacity utilization just came out. A little bit weaker than expected. Manufacturing production a little bit better than expected, and a nice upward revision. So nothing to write home about, nothing to move about ahead of the FOMC, but just an update there. Anyway, back to business. So dollar CAD is one of those ones I think you could get a decent rebound off this level. Here's what it looks like on the intraday chart. Literally, I mean, it couldn't get cleaner than that. Basic lower median line support. The 618 drifts down into 130.80, so if we do get a stab lower, that's where I would love to have a little bit better of an entry if we get one last drop into the US Open. Near-term resistance, you got 31.40. Near-term bearish invalidation, 31.69. That's your gap close from Friday, the median line off the high. And a break above that would signal a much stronger recovery, in my humble opinion, looking for a rally back towards this region, just shy of 33. This is what will pop it all off, though. This is near-term resistance, key support at 130.80. If we break sub 130.80, I'm looking more 130.10. I'm looking at like 129.58. But this is a big region of support. You're seeing divergence on the intraday charts. This is the 2-hour, or the 4-hour rather. Here's the 2-hour, more divergence. Here's the 1-hour. Whoop. There's some divergence, but nothing to write home about. And here's the 30-minute. Okay, so boom, maybe. Gap fill 130, 169. Break lower below 130.80. Big risk, big risk. Questions on dollar CAD before we move off? She's a beauty. I like her. It's been a slow grind to the downside, but you're coming in some final meaningful support. And just as a quick recap of why that level is so important. Key 618 retracement of the advance off the August lows, 200-day moving average, lower median line parallel, basic trend line support, all converging right here. Momentum at support at 30. Michael says, Mike, do you prefer entry or market order type with event risk trading? Mike, maybe it's a flaw with me, brother, but personally, I am never really a big fan of entry orders. You know, I will take, obviously, limits and stops are not negotiable, right? I'm never going to leave a trade without a limit or a stop on it. But, well, let me take that back. I've left trades without limits on it, but definitely not stops. As far as entries for event risk trading, I typically will take all market orders. That's just me. Sometimes you got to finesse the levels just right. You got to have your timing in. You kind of got to be in the groove. And a lot of times I like to be, you know, leave myself a little bit more time to react. You know, if the market just starts spilling and all of a sudden she comes out with a comment like there's a broader risk to banks or something completely radical comes out, I'm not going to have time to get in there and cancel that order. And if she says something like that, I'll have more wits about me not to get into the position than trying to fade a move if the market just drops and I'm sitting there trying to catch it. So that's just my personal opinion, Mike. I don't want to stray you away from either side. I can tell you that not using market orders has also been, there's been plenty of lost opportunity because a lot of times we have our levels mapped out and we know where we want to get in if the market gets there, and it's there in a blink of an eye, and you're just not able to pull the trigger. Now all of a sudden you're missed the position and you're chasing. It's double-edged sword. It's double-edged sword. Again, that's one of those things, Mike. It's like risk management, right? I can't really tell you guys what to do with that. It's really based on your character and what kind of risk tolerance you have. What's the link for the live feed on Yellen? There's no live feed. Oh, the live feed for the video, I'll tweet that link out on SB Squawk, Eileen, before the release. But this is the link for the FOMC page. Okay? And again, it'll pop up right here under the December read. Look for the PDF on the projections, just like September. Mike says, also do not feel comfortable with entry orders. Control freak, I am, he says. I think you're talking about you, right? Yeah, I tend to be a little bit more like to micromanage the position as well. All right, that's dollar CAD. That's number 5. Pressing into support. Look for that rebound and possible reaction above 130.80 into 131. Looking at sterling dollar, number 6. Here's what sterling looks like. So a fake out on a break yesterday or not? I don't know. Here's what the intraday chart looks like. What can I say? There's a reason I didn't highlight this yesterday. I'm not a big fan of how it opened up, and we kind of went through that 26.95, 27 handle, which was near-term bearish invalidation for me. So it took out our bearish bias, but then on the pullback, you know, it kind of whittled away at it, and here we are back again. I don't know what to do with this, guys. Again, a gunshot approach. If you put a gun to my head, I think that sterling does make another drop into the monthly open, trendline support. Confluence barrier gives you about 25, and you look for a support bounce there for an inevitable break of the highs. That's sort of my game plan. Now, that's a big range from where we are now, completely aware and cognizant of that fact. You do have the UK BOE, Bank of England, on tap tomorrow, so I don't want to take a stern approach, and out of all the dollar crosses, this is the one that still has more event risk on tap, even more so heading into tomorrow's release. So, I don't want to get too aggressive on the sterling. Bottom line, again, if you get a drop towards the monthly open, basic channel support, would be interested in taking a long trade. Other than that, you know, look for a break above 27.67. That's the barrier you need to clear to really validate a much more substantiated breakout in the sterling. So I'd be looking to buy dips on a break above 27.67, or I'd be looking to buy a drop towards 25 in the meantime. I think you're going to get a lot of chop. And the BOE is on tap tomorrow morning, so you want to take a little bit more of a reserved approach here on the British pound. Questions? Comwell, no, I haven't gone over crude yet. We're getting there. Michael, if you have time, would you go over dollar? Ooh, dollar Swiss. Really, Mike? On purpose, you want me to look at that? If we have time, man, I really doubt it, but we'll see if we have time. Let me run through these. I do want to go over pound yen. If I had to trade a pound cross, and you never really have to trade anything, but let me tell you guys, the pound cross I've been trading is what I should have been saying, is pound yen. And I know I talked to you guys about this yesterday, and then early in the week, and even last week, and the entire time we've been looking to play shorts off this upper median line parallel. You have a lot to look at here in sterling yen. And even the momentum barrier continues to mark some ongoing divergence, albeit above 70. I still like a possible turn lower. We're up against resistance, topside breach. You're looking for that median line, 148.20. You're looking for 152, essentially. That, barring that, the near-term risk is still for a pull while below this level. Remember, we looked at this yesterday as far as the sheer amount of 8-week consecutive advances off the lows, just out of control here, but never underestimate it. Right? We've had large runs like that before. Most of them have seen decent pullbacks in price. So going into the intraday chart, here's what it looks like. If you guys remember yesterday when I was telling you, and I was like kind of stomping the ground, throwing a little hissy fit because I had missed entry, that ended up being a decent trade. We went down from 146.40. The low overnight was 145.18, well over 100 pips. And that's where we bottomed out, just above the weekly open, near-term support, 145.12. So look for a break of this range. I know this looks minuscule on a 240-minute chart, guys, but this is a wide range ATR. A quarter of a daily ATR in pound yen is still showing 53 pips, 55 pips. Right now it's 51 pips, quarter of the daily ATR. So I'm still stalking for re-entries. Again, I do like the downside into the BOE even. It might be a decent trade. Keep in mind, this would match pretty well with what we're looking at with the sterling dollar on that drop into support, as well as dollar yen. And that's what's next on the list. Here's dollar yen. So early in the week, we talked about resistance at 115.52 into 116.08. 116.08 being the August 2015 low. and a nice key pivot range going back here a few years with that 618 retracement of the entire decline off the highs from last year. Well, perfect top tick reversal, pullback, still haven't gotten a definitive break, convincing break of the weekly opening range, and I want to see momentum go sub 70 here on a daily close. That would mark a little bit more of a meaningful near-term pullback in dollar yen. But if that does materialize, pound yen is sort of a really nice play to play both of those opinions, in my humble opinion. Again, pound pullback, yen strength. You see that pound yen reversal give you a little bit more of a pullback towards support. For the dollar yen near-term chart, here's what it looks like on the 2-hour. And let me take even a longer look at the 4-hour. Okay, pretty darn clean. You know the levels to beat. Again, last week's low, 113.15 would be sort of the support barrier I'd want to see give out to validate the break or the move lower. Again, such a scenario, you'd be looking for that 50 line. More importantly, you'd be looking at those former swing highs right around 111.45. So dollar yen levels, by the way, remain unchanged from earlier in the week. Questions on dollar yen before we move off? That is number 8. Okay, I just want to touch base real quick. I'm going to spend a minute on this Aussie CAD. This was an update that we had earlier in the week. I just wanted to highlight, guys, that same key resistance level is in view right now at 98.60. If this breaks on an Aussie breakout, look for a rally into the monthly open. That would be 99.20 basically into 99.25. Really nice pivot area. I'd be interested in shorts off of parity basically if we get up here. Nice pivot in price, former channel support. But largely speaking, watch that near-term breakout possibility here in Aussie CAD. Also to the upside here would be CAD weakness, and that would really fit well with our dollar CAD rebound off support. So sort of some really nice puzzle pieces fitting together here as we head into the FOMC. Fade on the dollar yen. That's my idea. It's the dollar yen. It's an abomination. So again, I wouldn't put it past this thing to make another tag of 116.08 or even the upper parallel here during FOMC. Okay, if she's all, if the dot plot shifts or you see a material shift in expectations for interest rates moving forward, I wouldn't even be surprised to see a 116 clip. Oh, excuse me, a 116.55 clip here. But no, largely speaking, yeah, I'm trying to fade this while below that median line, looking for a move lower in dollar yen. Ultimately, we want to buy along this median line. Okay, ultimately. But near term, I still think the risk is lower here for dollar yen. Okay, Aussie CAD at resistance. We just talked about that. Silver and crude. Conwell, here they come, my man. So real quick, crude is going to continue to be on the headlines, guys, just because of what price action is doing. Everyone's surprised this morning. I was on CNBC and they were saying something about them being surprised about crude. Well, they should have been in here with us yesterday because we were talking about this. Guess what? Yesterday's high was an exact hold of the monthly open right on cue. Excuse me, weekly open right on cue. And then we push lower, again, breaking through that 50 line. Still think you get a drop into this 51.40, 51.65 region. Lower parallel, June high, 1618 extension. You name it, it's up there. 2016 high day close previous to the break that we just made. Huge pivot region, right? So I think you still get a drop into that. Keep in mind that's also what you need to fill the Sunday open gap. Just lower 51 is that 100% extension. I'm going to go ahead and leave that on there and get rid of this 236. 5106 into 5160. Key near-term support here on crude. Here's a 2-hour. Here's a 1-hour. And in fact, if you take a slow parallel here, we're actually like right at support right now. You see that? So I'd be looking for some exhaustion side on the short side here heading into this key region. Looking for shorts after the two fades from 115.50 or below 114, Eileen. You're talking about dollar yen. Before I go back, any questions on crude, Conwall? Or anyone looking to trade this? I'm basically looking for the gap fill. I'm basically looking for a drop towards 51, 51.65, looking for some support there on the near term. If we break back below that, I don't necessarily want to still stay short. Your next downside target doesn't really come until 49.60, but I wouldn't be looking to enter new short positioning on a break. If you're holding shorts, great. I'd put your stop above 51.60 and let it drop. But to try to enter a short on a break below 51 is going to be pretty tough. You'd want to wait for some sort of zoom and retest before doing that. That being said, all things held constant, looking to wrap up short exposure into 51. Looking back to Eileen's question, looking for shorts after the two fades from 115.50. I'm not sure what you mean there, Eileen. Do you want to give me another breakdown? Or below 114? So definitely, if we break below the monthly open, 114.40, I would actually still be looking to sell a rally maybe back into the initial weekly opening range low, 14.70. Look for that drop into the lower parallels. Look for that drop into 113.15. Even if this rallies, like I says, back into 116, back into the upper parallel, it's going to be dependent on what the Fed says, but all things held constant, if what we expect is what we get, and price action just rallies in the dollar, I still will be looking to fade it towards that upper parallel. So on a rally rip higher, maybe a short off this region. On a break lower beyond the monthly opening range or the monthly open, I'd be looking for a zoom and retest to get back short on a move lower. Eileen, does that make sense? Basically, this still could be sort of a rounding process. So I wouldn't put it past this to give you a little bit more chop. And that's the only thing I want to say to everyone, guys. Expect chop today. It's not going to be a one-directional move. I mean, it could be. But there's going to be some back and forth as the market digests the projections, really takes into account what that means for interest rate expectations moving forward. And from there, I think we'll get a little bit more of a definitive directional bias moving forward. So that's silver. I do want to go over just silver really quick. That was crude. And gold, look, I don't really want to play with silver either. It's been a pretty lackluster range. As I told you, I was tweeting with you earlier, Conwall. Look, I'm looking for a possible spike still into 1740, maybe a little bit higher into the structural resistance zone, this confluence resistance zone here. But I think that's where you want to start looking for a little bit more, a little bit more rigid resistance, a little bit more of a concrete ceiling there for price. This is also going to be the broader bearish invalidation. So if you make a pop through 1750, you're likely to see a rally back towards 1780, if not the 18 handle. Area of interest for short exposure, near-term bullish invalidation at the weekly lows, right here at 1665. Okay. As far as gold is concerned, I don't want to do anything here in gold either. You guys are probably sick of hearing me saying that on these commodities, but levels are unchanged, and I do want to note that it's likely to be a market mover today. Typically gold's major functions in the markets have been inflationary hedges. So as concerns over rampant or front-running inflation start to become a little bit more widespread, you'll see gold catch a bid, or during those really strong risk-off environments. Don't necessarily you'll see either that today, but know your levels. Initial support 1142. Key support 1120, 1130, key resistance 1200 to 1203. I'd be looking to buy a dip towards those support levels, or if it rallies toward 1200 today, let's say the dollar really sells off, that might be a great opportunity to get back short, inevitably looking for a buy near 1130, 1120. So I'm going to keep showing you this chart every day, but it's still the same levels we're looking at, and they're still absolutely critical. Again, the weekly chart, has been the major thing I've been following for crude or for gold prices, and that remains unchanged as well. Okay, just to put things in the broader view of where we are in gold for the larger picture. All right, guys, I apologize. I am over on time. Any other questions before I let you go? Let me know. Mike, is the FOMC statement that will move the markets or the press conference? So, Mike, in this instance, yes, the FOMC statement in and of itself will move the markets based on the projections. If we go and we see a major discrepancy or change, okay, if we see a major change to the dot plot, if we see a major shift here, the markets will react instantly. Okay, the markets will react instantly to start repricing that in. Remember where we are right now. Okay, the markets are still flatline or still below where the Fed is actually projecting rates to be. And I think that's rightfully so. They've been horribly wrong on rates for the last 3 or 4 years, so why would it be any different, right? The question is, does this market expectation adjust to move even higher, or does it stand pat at where it is right now, which is below what the actual Fed consensus is? So that's what the initial move will be on. Mike, let's say we get the release, they raise interest rates by 25 basis points, the dot plot broadly remains the same, the projections as it pertains to growth, inflation, and employment remains the same. In that kind of scenario, it's the presser that's going to move it. It's probably going to be questions on this near-term rally that we've seen in stocks, the severity of the dollar strength that we've seen. There's going to be questions on Trump, no doubt, undoubtedly pressed on her. Like I said, I probably think she'll return with some fluff commentary. But that's the scenario, Mike, where you'd see the presser really be the bigger market mover here. What you want to pay attention to at 2 p.m. is definitely going to be any shifts or changes to the projections and any changes to the dot plots on interest rates. Okay, so keep your eyes peeled for Squawk on that. Okay, have fun in your favorite domain today. All thanks for the serious help and caution. See you tomorrow, says Eileen. Same to you. Guys, we'll see you all tomorrow. Safe trading today. I'll try to keep you updated on SB Squawk as best I can. Lower your leverage. Have fun doing it. It's going to be an awesome session. There's going to be a lot of chop and a lot of volatility. So again, tone it down until we get a clear picture and let the dust settle on that. Quick reminder, again, we'll be on board tomorrow morning at 8:30. Haven't come up with a schedule for the remainder of the month on the webinars, guys. We're obviously going to go into abridged scheduling starting next week for the holidays. So I'll give you an update on that tomorrow. But tomorrow morning we'll be here at 8:30 Eastern for another update on the aftermath, as it were, of today's release. And quickly reminder, tomorrow at 12 p.m. Eastern in New York, Jamie will be out with his midweek strategy webinar to wrap up the week. Best of luck trading, guys. See you tomorrow morning. Cheers.